There is a revision. I don't.
Okay, let's talk about IAS 37.
Yeah.
IAS 37 is dealing with provisions, contingent liability, and contingent asset. Okay, provision,
Yeah.
contingent liability, and contingent asset. Now, first tell me what is a provision.
It's a liability of uncertain timing or amount.
What does this mean?
Basically uh, it's basically like a liability, but you do not know when it took place or like a specific amount for it that like the
Okay,
value of it.
understand. When I talk about a liability means I am very certain. I am very certain that when am I supposed to pay the amount? I am very certain about the obligation, and it is an obligation that I have to fulfill. Something has happened in the past, and now I have to pay the amount. So now it is my present obligation that has happened because of the past event. And I know the time at which it is supposed to be paid. I know the amount that it is supposed to be paid, and I am certain that when I am going to pay it, just mark at the words that I'm using. And I am certain
Hmm.
that I am going to pay it, it will result in an outflow from the entity of the resources. So when I am going to pay a liability, it is going to result in what? When I am going to pay a liability, it will result in what?
Outflow
Outflow
from
of
the entity of profit.
resources embodying economic benefits. That means there is going to be an outflow of money. There is going to be an
Yeah.
outflow of resources embodying economic benefits. And this outflow is going to go out from the entity. So there is
Yeah.
going to be
Okay.
an outflow of what? Of resources embodying
Of resources
economic benefits.
embodying economic benefits.
So there is going to be a liability. The amount is certain. The time is certain. It is a present obligation, and it will result in
Present obligation.
outflow of
Outflow from the entity or outflow of resources embodying economic benefits.
it is going to result in what?
Outflow of resources embodying economic benefits.
Okay. So when there is a liability, amount is certain. Okay. What is there in the liability? The amount is certain. The time is certain. It is a present obligation. Can you please say what is happening in liability?
Yeah, it is a liability of sort.
Amount is certain.
Uh, yeah, okay. Amount is certain.
Amount is certain. Time is certain. It will result in an outflow embodying economic benefits. Can you please repeat what happens in a liability?
Yeah, the amount is certain, the time is certain, and it is the outflow of resources embodying economic benefits.
Okay, and it is a present obligation. But in
Yeah,
the provision is also a liability, but there can be two things. I do not know when am I supposed to pay, or I do not know the amount that is going to be paid. So in provision also, the liability is there. I'm sure that I have to pay, but I do not know the time. I do not know the amount.
okay,
In
okay.
provisions, the liability is certain, but I
Hmm.
don't know the time. I don't know the amount. So when I talk
Yeah,
distinguish between a provision and a liability? Can you give me a distinguish between a provision and a liability?
A provision is a liability of uncertain timing or amount, and a um liability is like it has a certain timing, an amount, and a present obligation, and it results in an outflow of resources embodying economic benefit.
Okay. So when I'm talking about recognizing a provision, when do I record the provisions in the book? Okay. When I'm talking about recognizing a provision, that means I know that I have an obligation that is supposed to be fulfilled. Okay. I can make an
Yeah,
estimate of the amount. I can make an estimate that this amount is going to go. And when this event happens or when something happens in the company, I am probably sure that an amount is going to go. I am probably sure that there will be an outflow of resources embodying economic benefits when I settle this amount. At that time, I create a
yeah,
provision. Okay, that
okay,
means I can make an approximate estimate of the amount. I have an approximate figure. I have an approximation. I will have to pay this, and well, while settling it, there will be an outflow of resources embodying economic benefits. At that time, I create a provision. Okay, so
yeah, fine.
I
Yes,
recognize it in my books. When the amount is virtually certain, that means there are more than 95% of chances, virtually certain, you will have these words over there. When it is virtually certain, and it is what?
hmm,
Virtually certain
watch
that
certain
the outflow will happen, then I will recognize it as a liability.
liability. Yeah,
I am virtually certain there is more than 95% of chances that there is going to be an outflow. There is more than 95% chances I know the timing. So when there is a virtual certain more than 95% chances of the outflow happening, then I will recognize it as a liability.
yeah,
And
okay,
when I am virtually certain that because of any event, there is going to be an inflow. Okay, there is going to be an inflow, then I recognize it as an asset. Are you with me?
yeah, yeah, yeah,
These words are very important: virtually certain, probable, possible, and remote. Now, when there is a probability, that means the chances of you paying it is between 50 to 95%.
yeah,
When the chances of you paying is between 50 to 95%, that event will result in an outflow of resources embodying economic benefits. In such case, you will recognize it as a provision. But if the event has a chance, probable chance of an inflow coming into the picture, then you will disclose it as a contingent asset. So if there are probable chances, 50 to 95%, where the event has an outflow of economic benefit of resources embodying economic benefits, then what do you do?
sorry, Miss, what?
When an event has probable
Yeah,
chances between 50 to 95% probable
yeah, so
chance
you'll recognize this
of,
as a liability.
no darling, if it is
No, no, sorry. Oh,
virtually certain more than
okay.
95,
Yeah,
liability.
then it'll be liability.
If
Fine.
it is probable between 50 to
Mm-hmm.
95%, between
It'll
50,
be recognized provision.
it
Yeah,
will be recognized as a provision. If the
provision, huh?
event has a probable chance of receiving an inflow,
Hmm.
then I will recognize it as a contingent asset.
Yeah, okay.
Okay. Now you talk about possible. The event has possible chances between 5 to 50, that means 5 to 49%.
Hmm.
When the
Yeah.
event has possible chances that it will result in an outflow of resources embodying economic benefits. It has possible chances that it will result in an outflow of resources embodying economic benefits. So in that case,
Hmm. So it'll be disclosed, like if it's an outflow, it'll be disclosed. Contingent liability.
and for
Yeah.
possible inflow, I'll ignore it.
You'll ignore it. Yeah. Hmm.
Possible inflow, I will ignore it. Now, if there are
Hmm.
remote chances, less than 5%, if there are less than 5% chances, be it outflow, be it inflow, you're going to ignore it.
Yeah.
So if you have a virtually certain chance of an outflow, virtually certain, so you should know virtually certain means more than 95. Either they give you percentage or they use the word virtually certain. So if there is a virtual certain outflow, then
So if it's a virtually certain, yeah, it'll be outflow will be recognized as a liability. If
even
it's an inflow, it'll be recognized as an asset.
you will use
If
the
it's
word virtually certain. Virtually
yeah,
certain.
virtually certain.
If
Yeah,
it's
yeah, yeah.
virtually certain
If it's
outflow, then
it'll recognize a liability, and and if it's an inflow, it'll be recognized as
virtually
a
certain. Virtually certain.
virtually. Okay. Yeah, Miss, why do you have to say it together? I mean,
No, say it, say it. If it's a virtually
okay.
certain,
Virtually certain recognize as. If it's a virtually certain outflow, you'll recognize liability. If it's a virtually certain inflow, you'll recognize as an asset. Yeah.
if it is a probable,
Outflow, you'll recognize as provision. If it's a probable inflow, you'll disclose contingent asset.
if it is a,
If it's a possible outflow, you'll disclose contingent liability, and if it's a possible inflow, you'll ignore it.
and if there are remote chances,
Remote chances you'll ignore in both outflow and inflow.
or in both. Can you give me the distinguish between a liability and a provision?
Yeah, so a provision is basically a liability that is uncertain in the time and the amount, and a liability is certain
There
with
are
the time
probable
amount,
chances, and there are
probable
probable
chance.
chances that it will result in
That it will result in
use that words
outflow.
of
Outflow of this thing. What is it? Resources.
embodying
Embodying the economic benefits. Yeah.
embodying economic benefits. And what about
Hmm.
this liability?
Liability. Yeah, it's uncertain. No, it's sorry.
Liability,
Liability is certain timing or amount.
virtually certain
Virtually certain.
liability. It is a virtually certain
Certain
liability
liability.
in respect to the amount and timing, which will result in outflow of resources
In
embodied.
outflow of resources embodying economic benefits.
Okay. So when it is virtually certain, it becomes a liability or an
Hmm.
asset. Okay. When it is probable outflow, it will
Hmm.
be provision. Probable inflow, it will be contingent asset.
Hmm.
When it is a
Yeah.
possible outflow,
Possible outflow,
it
disclose
is a
contingent
contingent
liability, and
liability.
you'll
So
ignore the
what are the
inflow.
scenarios in which do you create provision? Suppose you have a warranty, you have given some warranty to the people that if it gets spoiled within 3 months, okay? You've given warranty that if it
Yeah.
gets spoiled within 3 months, we can replace the entire product for you, or we will repair it free of cost. So there is a probable chance that the product gets spoiled within 3 months. So for that, whenever you give a warranty, you will recognize provisions for 3 months. If you give a
Yeah.
guarantee like Apple gives, If your product is spoiled, if you're taking Apple Care, within 1 year, we will replace the product. Okay. So if you're
Yeah.
giving guarantee, again, there is a probable chance that your product, the product becomes bad and it has to be replaced. So I will create a provision. Why do I say there is a
Yeah.
probable chance? Because it is between 50 to 95%. Okay.
Hmm.
Have estimated the future operating loss, like your provision for doubtful debts. Okay, this all you just need to know it. It is in ACCA. If you have an onerous
Yeah.
contract, environmental provisions, restructuring provisions, so they will tell you and you have to create provisions. Okay, so
Okay.
what is a contingent liability? You need to know the
Um.
definition of contingent liability.
mm, Yeah. So a present obligation that contingent liability, no, present obligation that arises from the past events
Okay,
and from past events, but it is not recognized.
you just disclose it. You do not record it in the books because there are possible chances. What is that?
Yeah, it's like
The
a prediction.
possible
Yeah,
chances
possible
it
chances.
may happen. So it is between 5 to 49% possible
Hmm.
chances that an obligation can arise. You are not very sure. It is
Yeah,
possible
yeah.
and probable. So that is a contingent liability. Remember,
Hmm.
contingent liability or it is a contingent asset, it is only disclosed as a note to your financial statements.
Yeah.
If it is a contingent liability or it is a contingent asset, it is only disclosed as a note to your financial statement. You do not make any entry in the financial statements. Okay,
Hmm.
come on, read this question.
Yeah. During the year 31st March 19, a customer commenced legal proceedings against a company claiming that one of the food products that it manufactures had caused several members of his family to become seriously ill. The company's lawyers have advised that this action will probably not succeed. Should the company disclose this in its financial
Will
statements?
probably not succeed. Okay, what is the lawyer
Mm,
told? That this will
That is
probably not succeed. That means there are how
so
many
probable
percent chances of it not succeeding?
50 to 95%.
Probable 50 to 95% chances
And it's an
that
yeah,
is
and it's an
going to
outflow.
succeed. Yeah. So now tell me what do I?
So you'll recognize this as a provision.
They are telling there is probable chances that it will not succeed.
Mm, 1 second.
So 50 to 95%
Oh,
the
one
chances
second.
that you will not have
Company.
to pay. If
Oh, okay, okay. So you
probable that
don't
you
have
will not
to.
have to pay,
Yeah.
so there is a possibility that you might have to pay.
Yeah, yeah.
So the legal advice is that the claim is unlikely to succeed. It is unlikely that the company has a present obligation to compensate the customer. So no provision should be recognized. However, if it is probable that it will not succeed, it can be possible that it might succeed. Hello.
Yeah, yeah.
If it is probable that it will not succeed, however, it can be possible that it will succeed. So you should recognize it as a contingent liability and you should
Okay.
disclose it in your financial statements. You should disclose a brief description about the nature of your contingent liability. As
Yeah,
an
so you'll use the
that
possible.
may if we lose this case, then maybe we may have to pay some money. Maybe there will be an outflow of resources embodying economic benefits. Are you with me?
Yeah, okay. Yeah, yeah, miss.
Come on, read the next question. We are being sued. Somebody has put a case against us. The legal team thinks that we have 75% chances of losing. What does the legal team think? Can you please repeat?
One, yeah,
So we have 75% chance of losing. So it is
75% chance of losing this one, which according to our legal team could cost anything between 50,000 to $300,000.
so our legal team thinks that there is a probable chance that we will lose 75%.
Yeah,
Okay.
yeah, so probable.
The court case where the company is being sued satisfies the over 50% probability rule.
Yeah, so probable 50% or
Yeah, but
90%.
the actual
95.
cost is uncertain. Actual cost is
Okay.
certain or it is uncertain?
It's I mean they've given a range, so
They have given a range that cost could be between 50,000 30,000,
50,000 to 300,000.
300,000. So IAS 37
Yeah.
tells you that what you
Make
have
a
to
note. Why note? Because it's probable now. So
IAS 37. So according to IAS 37, we would create a provision.
yeah, so recognize provision. Yeah.
Okay, fine. Next one.
Uh, all yeah. So one where we are suing another company, our legal team think we have 90% chance of winning this case, and we are likely to be awarded 200,000 in compensation. Okay, so 90%, like 90% they think that we'll win. So it'll be a 90% would be probable, and it's an inflow. So you will disclose the contingent asset.
Yes. Okay. So this is done as per the IAS 37. So
Yeah,
probable
okay,
is
fine.
what? Probable is more
Sorry, miss.
than
Yeah, probable is 50 to 90 percent.
50.
Yeah,
More than 50. Possible is
more
less
than
than
50.
50.
Possible less than 50, and remote is like little or no chance.
Okay, you know the accounting treatment of probable and possible. Yeah,
Yeah.
this is a past paper question. Define the term liability.
Liability is
Present
certain
obligation.
when, yeah, a present obligation arising from past events. Where miss, but why isn't the thing written where there was a certain time and amount?
You just have to answer for 2 marks.
Oh, fine. But you
There's
can write that
anything of
also.
a certain time or certain amount, the
Okay.
settlement of
So,
which would result in an outflow of resources embodying economic benefits. The
okay, okay,
more
fine.
better terms you use, the more the better.
Okay, so liability is a present obligation arising from past events, the settlement of which is expected the results of the outflow of resources of once again outflow
Embody
from the resources embodying economic benefits.
the provision.
Then there is
Provision.
provision. Provision is a liability of uncertain timing and amount to cover a probable future.
Okay. More than 50% chances. So this word is important. Which word?
Probable
Probable.
future.
Contingent liability.
It's a possible obligation that arises from past events and whose
Means
existence, uh,
possible means
um,
less than 50%.
possible was 50, less than 50, yeah, arises from past events and whose existence will be confirmed by only the occurrence or the non-occurrence of one or more uncertain future events,
Okay, fine. Come
not
again. Tell me what is
only
a
the,
contingent
yeah.
liability?
Contingent liability is a possible obligation that arises from the possible possible obligation that arises from the past events and whose existence will be according to the occurrence or non-occurrence of one or more
After
future
the
events.
occurrence or non-occurrence of any other future event.
Of other future events.
Again, what is a contingent liability?
Contingent liability is a possible obligation that arises from the past events whose existence depends upon the occurrence or non-occurrence of other future events.
Okay, now read this part, D part. Read.
Explain the accounting treatment of the expected compensation of 20,000 in financial statements by making reference to the relevant IAS.
Okay, what is the additional information? Read.
JPLC
Expected
needs,
compensation of 20,000.
yeah, okay.
You are going to receive expected compensation of 20,000. How
20,000. 20,000. So
much? Read this
expected,
additional information.
uh,
Read this additional information.
where is it? JPLC was sued by a customer for the breach of sales. The case will be heard in court. The lawyer advises the directors that it is highly probable that the company will be found liable and the compensation is likely to be $200,000.
20,000. High
Probable, na? So it
probability.
will,
High probability.
yeah, probable is 50% or 95%.
So they've given you high probable. They've not told you. So there is a high probable chances that you might have to pay. Probable. So what will you do?
So you will recognize it as a provision.
Okay. Now you have to explain this with reference to international accounting
So
standard.
as per IAS 37,
This you
it is
need
a
to memorize.
liability. Yeah. So as per IAS 37, it is a liability because it is a present obligation arising from the past events. And it is probable, which means it is more than 50% of the outflow of resources. So therefore, JPLC should make a provision of what was the amount? Yeah, to $20,000. Yeah, $20,000. So that will increase its current liabilities by 20,000.
Increase its current liability and it will reduce the profit by 20,000.
Reduce the profit.
Can
Yeah.
you again say you have to write it for
Okay.
6 marks? So what will you write?
Yeah, okay. According to IAS 37, it is a liability because it is the present obligation that's arising from the past events huh, and it is probable, which means it's more than 50% of the outflow of resources. So therefore, JPLC should make a provision of $20,000, which will reduce its profit by $20,000 and increase its current liabilities by $20,000.
So 6 marks, huh? You cannot avoid anything.
Yeah.
Completes
Fine.
IAS 37.
37.